right, let's start off then by putting the spotlight on early stage VC, that is BlumeVentures. The company, remember, has backed more than 150 startups, including the likes of Unacademy, Slice, Turtle Mint, as well as Carbon Clean and many more. The company has also marked the close of their first New Opportunities Fund. Here to talk about the fund, the potential outlook as well for individual sectors, as well as what the climate looks like in India, is Karthik Reddy. He's the chairperson, IBCA, and co-founder managing partner at Blume Ventures. Karthik, thanks so much for taking time out and joining in. Let's just start off by getting a roundup view from you as to how you're looking at the overall VC funding environment in India at the moment.
Yeah, I think I can speak more, Ravan, around venture, which is where we are involved and know the most. Venture is going through a tough phase, not because there's any shortage of liquidity, but there needs to be some sort of certainty of whether the business can get to profitability or the next round or to public. And I think that's not an easy answer for a lot of companies at a lot of stages, starting with Series A, where it looks the most dire in a lot of situations. Whereas in Series C and D, I don't think anyone's going to excuse an inability to get to profitability. So while that battle keeps going on, there's also the legacy issue where a lot of companies have now, it's been a year or so since there's been maybe not an infusion of capital into unicorns or late stage companies. And they've had to work with the resources they have to try and turn profitable. And if that is not clear and visible to a lot of the existing investors, they tend to be nervous about adding new bets. So there is risk taking. It tends to be therefore smaller in size earlier and more palatable in terms of risk appetite rather than taking large, deep bets at this point. So I don't think we'll get back a year like 21 until 25 at least, but we will see the steady trickle of companies which have very, very aligned market forces driving them, as you can see in climate tech and in certain areas where companies are closer to a path to profitability and public. We are seeing capital, but it's definitely much slower than before, as you can see from the statistics.
Now, Karthik, you have said in the past that you're very confident of India turning. Now you're pretty convinced that we can see large segments of the economy actually being built by what you call new generation of digital first or tech first entrepreneurs. Can you just elaborate a little bit more?
Yeah, I think while a lot of business models are ripe for disruption because the fundamentals of how the businesses are built are going to be sort of tech first. So even when you're building today the new age P&Gs and Maricos, which are traditionally hardcore consumer businesses, you can't think of them unidimensionally as an offline first distribution model and then think of online. Pretty much have to do everything at the same time. You have to, when you look at financial services, to see new value creation at this juncture, new enterprise formation, to think of a traditional way of building it through entirely offline distribution and offline infrastructure, banking branches. It's just silly, right? And so eventually that advantage then shifts in terms of teams which are built tech first. And I maintain that a disproportionate amount of future economic growth and share of GDP will come to businesses which are better equipped for that. So of course, incumbents will compete. There's no doubt about that. But when it comes to new venture, new enterprise formation, the advantage lies with teams which think through these models, digital first, tech first. And the infrastructure, of course, there's a spectrum of this. Somebody who's using a cosmetic brand can only use it physically and they need to get that good physically. So e-commerce is at one end of the spectrum, whereas on the other end, you would have something like financial services, which is entirely likely to be more of a flavor of fintech going into the future rather than relying on how they were traditionally done, whether it was insurance or whether it was wealth, whether it was investment or it was banking. And so I continue to be a believer on that, but I will not even remotely try to link your first question with your second, because I don't think it has anything to do with short-term capital and their ups and downs in driving long-term secular trends on how large enterprises will be built over the next decade or two. Nothing's going to happen in a year or two, right? At most, you're going to see foundations of some of these businesses becoming stronger. But eventual wealth creation, value creation in those businesses is going to take a decade to build any which way.
So what kind of scale are you looking at when it comes to global B2B customers actually accelerating, growing their overall productivity, scaling up, growth possibilities? What exactly is the kind of potential that you foresee, Karthik?
Yeah, I believe for all the naysayers that existed that, build great product companies out of India for the rest of the world, say primarily the US, which is the most lucrative of the markets, the most well-defined, large English-speaking market. You're seeing various, again, it's inevitable that you'll see slight differences in models. You're seeing a company like RateGain, which is listed on the public markets, which is growing through inorganic growth and probably has a more heavy European base. And you're seeing a Freshworks slowly scale back the little bit of a setback in the public markets to continue showing strong growth. And so you have, in each of these spaces, you'll have sort of a leader in how the playbook is being evolved. And while unicorns are not necessarily a measure of end state value, the fact that we have 15, 20 of these in B2B software products selling predominantly globally is fantastic. And then you have a Darwin box, which sells only to Southeast Asia, right? So, and even within our portfolio, we've seen now maybe 10 companies inching on 100 crores plus revenues, some selling only in India, some selling in the region, some selling in the US. And so it's fantastic to see that kind of scale. You can't have a artificially large number of these kind of companies become billion-dollar companies or all list. There will be a lot of M&A. I think the sector is prone to M&A because the innovation and the customer base and the product profile is global by nature. All our B2B exits through M&A have all happened between $30 and $50 million. So both M&A, long-term India listing opportunities, potentially building a few global multi-billion to $10 billion outcomes, all seem highly probable compared to 6-7 years ago. And the top of the funnel is looking fantastic. So I continue to be a believer in this space, but it's a subset of the entire Indian venture ecosystem. I would say 25% of the value creation will happen on global software products being built out of India.
And what's the outlook on agri-tech? Because there has been some amount of exposure as well to that space in terms of investments. How are you looking at the long-term growth prospects?
Yeah, so I think agri, at a macro level, I recently saw some stats. I'm not an expert in it. I mean, there are funds like Omnivore and Ankur, which have a much higher proportion of their early stage investing in agri. It's a smaller subset for us. So take my views with a pinch of salt. But firstly, I don't think, despite climate change, despite where weather patterns are going, just given the size of the market that India is for own consumption, we're never going to give up on agri. We might move labor force away from agriculture, which was the historic problem that too many people were in villages doing hard hand labor, to more mechanized labor, larger farms, consolidation, bigger, larger number of cows per farmer, for example, in milk production, more organized farming in terms of acreage and crops. So directionally, I think we'll have to move in that direction, right? But what gets grown in a half-acre plot is sadly just fulfills the demands of, that singular farmer family for their home and their village and that micro market. That said, it's very encouraging to see that India is one of the top producers in a whole bunch of agricultural commodities and crops, and global one in things like milk, etc. So I don't think the demand or the size of the industry is going to shrink.
It is fairly critical right now for companies to technology. You did speak about those tech-first entrepreneurs. So do you think that those companies that do have technology at the forefront are only likely to do better and continue to scale up? How critical is it, according to you, to leverage the technology component?
I think the current popular view is, so I think both on the consumer side, a company adopting AI becomes important because I think it becomes a toolkit which is important for an app experience or for a website experience, because consumers fall in love with products that look magical, right? And AI gives you a shot at doing that. Like, can you cater to, like the perfect meal suggestion for me, just given my prior behavior? Can you make it more healthier? Which is like, oh wow, suddenly Swiggy is taking care of my health as well. So that I think is the application layer of it. No one's expecting something to come out of the screen at them and look and smell like AI. And I think it gets more powerful. It was already there, by the way. It's not like it wasn't in terms of data models before this, before large language models came. So one is I think the misinterpretation or illusion that AI didn't suddenly came upon us in the last year or so. I think a touch and feel version of consumer AI came to everybody's desktop, but it was widely being integrated into various product offerings, both on the consumer side and the enterprise side for the last decade. So that could be, computer vision, it could be data modeling, and all of these were the ones that are creating the magic and giving you a lot of insights when you open an app. So from a consumer side, I think that will continue. And if companies don't adapt, they will look like they're archaic products. On the enterprise side, I think it's even more profound, the change. Because what then happens is the vast amounts and reams of information and data that get generated inside of an organization or an industry. The ability for non-humans to absorb that just accelerates the both speed, quality of decision making, and basically doesn't need human beings to be involved in discerning, what data is useful and what's not within a particular enterprise's offering. And so I feel there's adaptation, not just adaptation, but every software company that's building for enterprise use cases has to think AI first. Right? I don't think the product layer cannot have AI baked in. And I think this is the popular view. And once again, I don't think anyone pays for something because it's AI enabled. It sits in the architecture of the product. And if you don't adapt, you will die, I feel, when it comes to large scale enterprise sort of use cases.
So take us through then the promising sectors. According to you, what's looking good from an investment standpoint?
Oh, that's always a favorite question, but there's no short answers because the long haul is the key word there. See, in the long haul, I think everything, if you go and play back history, even the most boring of sectors re-evolve in every 10, 12 years. So you can think in 10-year cycles, perhaps. So maybe I'll answer it from that lens. I think part of the buzz is hype, part of it is real. I think what's happening is a lot of the hard work in terms of, it's just like what you saw in UPI and UID from 2016-17 was wide availability of both the infrastructure and the tools to use that infrastructure, which was a low-cost mobile data phone, right? You're going to see a similar impact when it comes to anything that relates to climate, for one. You're going to see a similar second-order impact of what happens when GDP per capita starts growing beyond $4,000-5,000 in India. So which means I was talking to the founder of Carrot Lane today. If there was a certain segment of people who could afford a 15,000 rupee or 10,000 rupee product, which is, sort of lower cost, affordable jewelry, that universe suddenly explodes to 4 times the size, 5 times the size. So if you're building for this bump up in disposable income, I think you're sitting very pretty.
Well, as a firm that has backed EdTech companies like Unacademy, we've seen what's really played out, for instance, with the Byju's. What's your outlook on EdTech as a space? Do you think that it has indeed hit a peak?
It hasn't changed fundamentally. What we mean by that is anything that is on the path to employability and income generation is evergreen. I mean, this is the only way India gets itself out of each $1,000 mark on per capita GDP. It's not going to come in any other way. It's not going to come with manual labor. It's not going to come from agricultural labor. It's not going to come from simply manufacturing labor. So our edge is going to be to continue churning out using our population advantage and our demographic dividend, the youth of this country at a higher level. So the market or the ability of people to pay for education is probably even more than people are willing to spend on weddings and holidays. So the profit pool is large. The revenue pool is very large. To that extent, it is going to be an interesting e-commerce, or rather commerce play for a long period of time. So that's step one. Step two, the way it was approached with, that I think got an artificial uplift during the pandemic. And education is not easy to do online. Education is easy to enable value addition online. Fundamentals are tougher. And so you can see there's a very large skew.
Any recent investments that you can highlight that BlumeVentures has made through the new fund? What's the outlook?
Been obviously slow and contemplative like most others. I think partly the environment as a whole, you have to do a double take on who will cut the check after us. Are we sufficiently capitalizing the company so that they don't have to raise for another 2 years? So you have to give them enough time to prove themselves. So that's been happening. We've been over-indexing, therefore, on slightly later stage founders or plays. We invested in an interesting sort of commerce enablement company called Flash recently. Just today, I think Sajid announced DPD Zero, which is enabling loan collections from bad loan books and bringing a very fresh approach to the problem. Again, these are evergreen problems. They'll never go away. Whether our founders build a great business out of it or not, the problem sets are going to be there. So that's what we are focusing on, companies of this nature, where we think the problems are evergreen. Founders are deep domain experts. This Flash guy came from Flipkart. The DPD Zero guys came from building communication stacks, and they think communication stacks are the way to solve the loan collection problem, not simply, pressurize people to pay back their loans. That never works. So I think we're looking for differentiated, fresh approaches which solve traditional problems, give them enough capital to run for 2 years. These are all big $3-4 million rounds. And then, we'll see what next year holds on the back of these kind of bets.
And I'm curious then, Karthik, to also get in your take as to what the view is when it comes to the listed space. How have you looked at the overall valuation metric, recent IPOs? Is there anything that you're eyeing by, way of companies that are listed and are interesting opportunities?
Yeah, I think, no, we don't have that kind of exposure. I don't have a strong personal preference. Life's being consumed by what we do at early stage. For the first time, we have a few companies in the SMB listed space. For the last 5 years, we got a couple of companies listed. We are pushing very hard, trying to educate both our portfolio and put out a public narrative out there saying, listed is not such an ominous thing. It's probably the right solution for someone who's built or getting close to profitability. Even if it felt subscale, I think it was artificial. If you're today a 250, 200 crore to 500 crore revenue business and you can be profitable, then you should list and you can grow 5x and 10x after listing. That way everybody wins, right? Everyone takes the exits when they want, and new investors get to participate in the journey, and domestic money gets to participate in the journey. So I think for me, at a personal level, it'll be a huge win if we see more of those. And to the extent that a handful of them went public in 21, I feel some of them were mispriced assets, too exuberant for that market. Hoping that the market prices all the growth for the next 10, 15 years is kind of silly. They've all corrected, which is not a bad thing. The other beauty of having a few listed companies, it sets fantastic benchmarks for the reality of the unlisted space, which we didn't have before. Now we have for the last 2-3 years. So Purple in our portfolio always now gets benchmarked to Nykaa, right? Lenskart will get benchmarked to Purple or to Nykaa. Lenskart will then become a second benchmark for anything in consumer brands. Mamaearth is filing, they will go. I'm not a judge, to be honest and blunt, about any of those companies and the right valuation of whether they're a good buy or not. All I know is that they've made the right decision to now say to the world that we want to continue building for 10, 15, 20 years. And it's fantastic to watch. We need 100 tech companies to be reasonably profitable listed companies by the end of the decade, right? And so this is still my dream. This is what I hope to see. And it's fantastic that an India Mart, a Teamlease, a Nazara, all of these folks took those calls and they're being paid richly. You saw Nazara's recent raise, it was a blowout success. Folks like Nikhil put 100 crores into the company. So they're showing their ability to consistently grow organically and inorganically in the market profitably. And that's it. In every sector, we need 2-3 leaders of this kind. And that just enhances the quality of both the private market and the tech market whole. I would love to see a 30 company tech index by 2030, which is as good as the NASDAQ.